headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We are just about 13 minutes away from the CDC's latest mask update. We'll have that for you here on Bloomberg Radio. Equities lower across the board right now, but we are well off session lows. We have got the S&P down 32 points right now ahead of earnings. S&P down 0.7%. The Dow is down 158, lower by about 0.5%. NASDAQ down 223, a drop of 1.5%. The NASDAQ 100 index also down 1.5%. Tech-heavy NASDAQ 100 heading toward its biggest one-day drop in more than 2 months. Lots of earnings, mega-cap tech stocks after the bell, including Apple, Microsoft, and Alphabet. They're all lower ahead of those reports. Right now, Apple is down 1.6%. Shares of Alphabet down 2.3%. Microsoft down 1.2%. 10-year yield 1.23%. We've got gold up 0.2%, 1,800 the ounce. West Texas Intermediate crude down 0.5%, 71.58 a barrel. The U.S. government has sold the only copy of the Wu-Tang Clan's Once Upon a Time in Shaolin. That's an album that had been owned by pharma bro Martin Shkreli. The price and identity of the buyer is being kept a secret per terms of the sale. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Carol, was it you? Did you buy it?
What?
The Shkreli?
No, I did not.
You're not the secret buyer?
I am not the secret. Did you buy it?
I didn't buy it, no.
All right, maybe Charlie. Charlie, did you buy it?
No, I know who it is. Dave Wilson.
Dave Wilson.
Dave Wilson. That makes sense.
Perfect. All right, well, this week's cover story of Bloomberg Business Week magazine happens to be among our most read stories today on the Bloomberg. You'll understand why in just a moment. It's about Beijing's crackdown on its big tech companies, how it is ushering a new era. So let's get to it. It's something we've talked about already a lot.
Yeah, Joel Weber is editor at Bloomberg Business Week. He joins us in the Bloomberg Interactive Brokers studio. Also, Austin Carr, technology reporter for Bloomberg News, joins us on the phone from L.A. My biggest question, Joel, with this story is, did Austin get to go to Grand Cayman to actually report it? Because that's how the story opens.
Yeah, not to my knowledge, but
you haven't gotten the expenses for July yet.
I haven't got those expenses, and I was thinking as you said that he just did that cover story not that long ago about Margaritaville, which maybe that did take him to the islands, and I just didn't put two and two together. But, I think this story is super significant. When I think about storylines through the year, this one is increasingly feeling like the story of the year, which is this China crackdown and what it really means. Because I think forever, investors especially have always felt like, oh, wow, this is China. This is a growth story. And like the tech versions of companies coming from China can be very different than American versions, and just seemed like that the sky was the limit. And then the sky has basically been brought down, and especially just the events of the last week. So we felt like that was, especially relevant for the cover this week. So Austin, can you tell me, we set you loose on this story, and what really stands out to you about what China is doing right now? Because there's a term that you drop in the story, the China model, that I'd like you to explain too.
Sure, yeah. And just up top, I should note that I am in Los Angeles reporting, not in the Cayman Islands on a beach somewhere.
How do we know that?
Yeah, it sounds like
I hear the surf in the background.
I can neither confirm nor deny.
But I do agree. This is one of the big stories of the year that we're really eager to focus on when it comes to Silicon Valley versus China, because for so long they were sort of emulating the model that the U.S. had done with their tech industry. For every version of Facebook, there was a version of that in China, or there was Baidu, the Google of China, or Didi, the Uber of China. And until just about October or so, that model had just continued growing and growing, and they were becoming more global competitors. But with these recent crackdowns on Didi, on Alibaba, on the education industry, on Meituan, we're seeing a lot of upheaval in that model, where China is basically saying to its entrepreneurs, no, this has got to stop. no more, freewheeling capitalism. We're going to rein you in a bit, and we're going to do it a lot faster than the U.S. regulators can do it in the U.S. And I think the big standout thing for me, and we can talk more about the new model for China, but the big standout thing is that going into this, I assumed we'd hear a lot of negative reactions of the government intervention in China, and it was actually quite the opposite. We actually heard a lot of positive reactions, especially from the startup and VC community, that felt like this was going to level the playing field in the China tech scene in a way that won't happen in the U.S. tech scene for many years.
So why is the Chinese government no longer taking a permissive approach, Austin, when it comes to big Chinese tech companies?
There's definitely a sense that these companies were getting too powerful. Alibaba being the prime example, where it was acting with a lot of monopolistic behavior, alleged monopolistic behavior towards some of the startups, forcing them on their platform, forcing smaller players to sell out, taking advantage of their data, and really behaving in a way that was in the corporate interest, but not necessarily in China's national interest. And I think that's really where the big pivot is happening in China right now. When we think about antitrust cases in the U.S., that's often to protect the consumer, but in China, it's increasingly to protect national policy. And so when these companies were veering off track, not behaving in a way that was in China's national interest, that's when the government has stepped in and say Alibaba or to Didi or Meituan that they have to behave differently.
Reading this story, Austin, and just hearing you describe it like that, I think some critics of U.S. tech companies could say, hey, wait a second, this is what we see U.S. tech companies doing to their smaller competition.
Correct. I mean, we did hear that. I mean, one person had told me that, China was able to rein in Alibaba within 4 months, whereas it's going to take U.S. regulators, years and years, if not longer, to rein in a company like Facebook or Google about their alleged, privacy issues. And so basically what we have to look at is what is the outcome of these two different approaches to regulation. On the one hand, critics and observers believe that U.S. tech companies might have a bit more of an edge in the global scene. Facebook, the FANG companies will continue to grow at a more global scale, where China's model is now becoming increasingly China-centric and also less founder-centric. In other words, sort of the sort of heroes of the tech industry in Silicon Valley, like Alibaba co-founder Jack Ma, might not be as vocal or as present as sort of their counterparts in the U.S., like Elon Musk will continue to be. And so there's just a give and take there. On the one hand, China might have less global champions, but perhaps that sort of reining in the top players allows a new generation of startups to grow, whereas in the U.S., startups are finding it difficult to grow without being swallowed up by the bigger players.
Austin, what have you not said that you needed to say?
I've not said that I will be filing an expense report.
Okay. And you're like, I better get to the Grand Caymans just to do some last-minute fact-checking. Right. Okay.
Well, it's interesting. I read your story and I was thinking, okay, the EU is leading when it comes to climate change, regulatory moves. I feel like China is now leading the way when it comes to big tech oversight. What's the U.S. role in all of this, and what does it mean for U.S. big tech companies?
I think the U.S. is still figuring that out. I mean, we've seen so many hearings. We've seen sort of fines levied in the EU and the U.S. towards certain companies, but it has not played out as aggressively in the U.S. as it has in China markets. We are seeing sort of U.S. companies having to, one sort of interesting juxtaposition was on July 4th. This is days after Facebook has been dealing with issues around government intervention, what's going to happen with some of the antitrust suits against them. And you have Mark Zuckerberg gliding on that hydro surfboard on July 4th on Independence Day carrying the American flag. Compare that to someone like Jack Ma, who's basically disappeared in recent months, and we haven't seen him. And you can really see the stark difference between how much pressure the U.S. tech companies, the largest giants, are facing versus the Chinese tech companies. But I would just really stress that this is a nuanced, complicated issue, and the idea from a Western perspective that China is just breaking down their big tech scene is not correct. They're just trying to tell them what they can no longer do.
It's the perfect read right now.
Investors, U.S. investors, are going to love the American tech companies even more, though.
Right, as a result.
That's the big takeaway.
Well, it's a must read, and check it out. It's the cover. Joel Weber, editor of Bloomberg Business Week. Austin Carr, technology reporter here at Bloomberg News. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We move into the final hour of trading. We are 1 hour away from the latest numbers from Apple, Alphabet, and Microsoft. Shares of all three companies trading lower along with the rest of the market. Right to the numbers. We'll give you the why in a moment. S&P down 28 right now at 43.94, retreating from a record, down 0.6%. The Dow down 137, down 0.4%. NASDAQ down 195, a drop of 1.3%. The NASDAQ 100 index down 1.3%, heading toward its biggest one-day drop in more than 2 months. Right now, we have got the 10-year up 16 seconds, 10-year yield 1.23%. Gold up 0.1%, 1,800 even the ounce. West Texas Intermediate crude down 0.5%, 71.57 a barrel. Equities lower as mega cap tech stocks, including Apple and Microsoft, tumble ahead of their earnings reports due out after the close of trading. The rout in China, as we were just talking about, adding to global market unease, with investors already concerned about the economic recovery given the rise in the COVID-19 Delta variant and central bank talk of tightening policy. Victoria Fernandez is chief market strategist at Crossmark Global Investments.
I think people are taking a step back. They're looking at what their holdings are, and our global equity income strategy, we actually don't have any exposure to mainland China and maybe only about a 1% exposure to Hong Kong. So I think people are doing that, right? They're looking at their portfolios and saying, do we reduce some of our exposure to some of these areas where there is increased uncertainty? But I don't think we'll see a full contagion, at least in the short term. We're not sure how it plays out longer term at this point.
And again, ahead of earnings, Apple down 1.3%, Alphabet down 2.1%, Microsoft now down by about 0.9%. Tesla reported last night, down now by 2.8%. UPS reported this morning, down 7.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
TikTok, everybody. We are waiting from the CDC a bit of an update when it comes to COVID and mask wearing. So as soon as that begins, we will take you there live. In the meantime, you know what also got underway today?
The Federal Reserve.
2-day meeting.
Busy.
Yeah, and we're going to get that decision tomorrow. Let's find out what we should be watching out for. We've got a dynamic duo. Steve Skanke back with us, Chief Economic Advisor at Kill Point, former U.S. Treasury and White House National Security Council staff member based in Washington, D.C. That's where we find him on the phone. And also with us, Frances Donald. She is Global Chief Economist and Head of Macro Strategy at Manulife Investment Management. She, too, back with us on the phone from Montreal. Frances, Steve, so nice to have you here with us. Frances, let me kick it off with you. What is it? I mean, is it going to be a boring meeting? Can I just go out for a 3-martini lunch and then come back when it's all over? Or should I be closely listening and watching?
Sometimes it's better.
I'm not a martini kind of gal either, so I don't even know why I said martinis, but go ahead.
Well, you might have the right strategy because there's always an emphasis on trying to parcel out word by word. I think they can probably get away with not doing much tomorrow, but the question, of course, is when is this taper coming? Is it going to be MBS or UST focused? How much warning are we going to get? My view is it actually doesn't really matter. Whether we get a September taper or a December taper, that's not the underlying question that has spooked markets here. The question is, did the Fed really have a change in their policy-making reaction function with average inflation targeting? They're focused on broad-based and inclusive employment. Do those 2022 rate hike dots really matter? Are we just going back to pre-COVID style monetary policy? So the most important question I'm looking for is, does Powell in some way push back against those 2022 dots, push back on the idea that AIP was just lip service, and give us some indication that yes, taper or no taper, they will be very patient on rate hikes. 2022 has to get priced out a little bit more, I think, for this curve to start re-steepening.
So, Steve Skanke, come on in here and weigh in on this. Do you agree with Frances that that is the most important thing we should be keeping an eye on when it comes to what we hear from Jay Powell and the Fed tomorrow?
Well, it certainly is something that we thanks for inviting me.
Yeah.
It certainly is something that we want to be paying attention to. I think the big challenge for tomorrow is for the Fed to not walk back from its somewhat hawkish outcome with the change in the dot plot from its meeting a month ago, and at the same time to acknowledge that the COVID-19 Delta variant could become an issue. We see some of the indicators of economic growth slacking a little bit. The Fed hasn't seen its employment growth numbers achieved yet. And so it wants to keep the stimulus on, but at the same time doesn't want to disappoint the market that it is giving up its vigilance on inflation. The inflation numbers are really a conundrum for the Fed because when you drill down into it, numbers like housing or shelter, which is 33% of the CPI basket, only up 2.5% over the last 12 months through the end of June. And for anything really to happen that's not transitory in inflation, you have to see some basic shift in something, in shelter, medical services, food at home, and there just hasn't been that there yet. So the Fed needs to assure markets, but yet at the same time acknowledge what it always acknowledges about we haven't seen substantial progress yet toward our goals.
Right. The bond market would tell you that, we're in on that narrative. We've got the 10-year note right now at 123. Francis, what about, though, the financial markets? We are seeing some pressure today because of the big tech names, although we're coming off our lows, concerns about earnings, concerns about outlook. It'll be interesting to see what these big companies, what do we have, Tim? We have Apple, we have Google, Microsoft.
Starbucks.
What they say about, the variant, the, Delta and COVID. How much do you think, we know the Fed watches financial markets, how much do they watch earnings as well in terms of figuring out what the growth and inflationary trajectory might be?
Well, I always think of the Fed like macro strategists. Maybe that's my own bias. But if they're like me, and I think sometimes they are, maybe I'm like them, what they're probably looking for are clues within those statements regarding a few key issues that are really creating massive uncertainty for the outlook. One is supply chain disruption. And we may not think that shows up in maybe tech earnings to the same extent, but any indication that those are either falling back and abating or persistent problem does change not just the inflation outlook, but the growth outlook. They're likely going to be listening for comments about labor shortages and any indication that maybe some of that labor force participation rate is coming back and how that's going to be impacting wages. And then if they're like me, they're also looking in earnings for any indication about how government spending ahead might change the outlook. These are three huge uncertainties that aren't just weighing on central bank reaction function or the way we construct asset allocation portfolios, but individual companies in America as well. They're creating this breadth of uncertainty that means we don't have clear vision on what growth, inflation, or policymakers are going to be doing ahead. And that's the underlying problem. That's the nerves you're seeing in this market, is this complete lack of visibility.
Stephen, we only have about a minute left, but I'm going to ask you the question we ask each and every time there is a Fed meeting. What's the question that you ask Fed Chair Powell tomorrow if you were given the chance?
And just got about 40 seconds.
Sure. Well, at Keel Point, we're watching for any indication that's going to drive markets one way or the other. So I guess my main question for him to be would be, okay, so you talked about talking about tapering. So this time, did you actually talk about it? And do you have a plan? And when will we expect to see that plan? Do we have to wait till after August? Do we have to wait till September? And while I agree that it doesn't matter so much as to when it starts,
right?
Markets would like to know when they're going to get on with it.
Steve, really quickly, do we hear Delta being said more tomorrow or transitory?
I think probably Delta more tomorrow, although this is their first meeting since the June inflation CPI, so probably transitory is going to be in it too.
Francis, 5 seconds. Delta or transitory?
Delta. What is going on in the housing market? Are they afraid that it has bubble components? That's my question.
Francis Donald over at Manulife and Steve Skanke over at Keel Point. Thank you so much.
Let's get a check of the latest world and national news with Nancy Lyons in D.C. Hey, Nance.
Hey, Tim, the CDC is revising its mask guidance and recommending people vaccinated for the coronavirus go back to wearing a mask indoors in certain areas of the country, seeing a surge in cases. The Delta variant is apparently taking hold in states where vaccination levels are low. The current vaccines do remain effective against the variant. The CDC is also recommending masks for all students and teachers in classrooms this fall. Well, if you're looking for the best hospitals, Bloomberg's Ann Cates has a list of where to start.
For the 6th year in a row, the Mayo Clinic in Rochester, Minnesota is the #1 hospital on U.S. News and World Report's annual ranking. The Cleveland Clinic is at #2, followed by UCLA Medical Center at #3. Rounding out the top 5 are Baltimore's Johns Hopkins and Massachusetts General Hospital in Boston. This year's assessment added new ratings covering heart attacks, diabetes, and hip fractures, along with other conditions to the list of medical procedures. In Washington, Ann Cates, Bloomberg Radio.
The bipartisan House panel looking into the Capitol riot has been hearing from officers today who defended the building. D.C. Metropolitan Police Officer Daniel Hodges minced no words in his opening statement, calling them terrorists. Hodges was the officer seen on video being crushed in a doorway of the Capitol.
The mob of terrorists were coordinating their efforts now, shouting heave, ho, as they synchronized, pushing their weight forward, crushing me further against the metal door frame. The man in front of me grabbed my baton that I still held in my hands, and in my current state, I was unable to retain my weapon. He bashed me in the head and face with it, rupturing my lip and adding additional injury to my skull.
Hodges says one rioter tried to gouge out his eye. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists.
All right, Nance, thank you so much. Just to reiterate what we just heard from Nancy Lyons, because it's just crossing from the CDC. We're not going to take you live to that briefing with Rochelle Walensky, head of the CDC, but the headlines include new science requires the CDC to update mask guidance. Rochelle Walensky, speaking in a briefing, some vaccinated people infected with Delta may spread the virus. This step could have been avoided with more vaccinations. Tim, those are some of your key headlines there.
Yeah, key headlines. And look, just like we heard from Dr. Levy earlier in the show, the point is now to get as many people vaccinated as possible. Mm-hmm. And the science on this is evolving. We've heard that from the beginning.
Right, exactly. In the meantime, we're going to just bring you another story. So we're watching that on the Bloomberg. This story, though, by our Kat Doherty, is something that always gets everybody's attention. The pass rate for the Chartered Financial Analyst Level 1 exam administered in May was the lowest since testing began back in 1963.
25%, Carol, of applicants passed the latest test. That's down from 44% of those who sat for the February exam. That's according to the CFA Institute's website. The 10-year average pass rate is 42%. So what do you think happened? Do you think people got vaccinated and they just went out and they didn't study?
I don't know. People were home, or maybe you're right. The world was reopening and they're like...
People were home for that February one, but maybe for this one, it was administered at test sites around the world. 26,000 candidates sat for the Level 1 exam, this according to the CFA Institute statement released today.
So the organization behind it all says, while some impacted candidates were able to pass, we believe the stop-start nature of the deferred candidate studies is reflected in the overall passing rate. Historically, the Institute offered all 3 levels of the test on paper in June and another chance to take the first part in December. After transitioning to computer-based testing, the Institute now offers the exams more times throughout the year.
Passing all 3 CFA exams can lead to higher salaries and better job opportunities. Candidates on average study 300 hours for each level and take 4 years to complete the series.
Erin Taylor Riggs, I remember I'd be working here late at night and I'd look over at her and because she would often be in early, she was a producer I think at that time, and I'd look over, what are you doing? She's like, I'm working and studying for my CFA.
And she passed.
And she did pass. Obviously not a lot though recently. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Techs tumble ahead of earnings. We've got the Dow, the S&P, NASDAQ 100 index all lower across the board. Let's head right over to the first word breaking news desk. Lots going on. And with today's afternoon call, here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks are under pressure, but well off their session lows. Dow still down 145 points. S&P's dropped 30. You mentioned NASDAQ. It's down 215. The U.S. 10-year-old drops to 1.23%. Gold is little changed. And transports plunge 322 points after a 7% drop by UPS after its results. Among the main 11 S&P sectors, only utilities, real estate, and healthcare were in the green. Consumer discretionary, telecom, and tech were under pressure. And leaders to the upside in the Dow, McDonald's and Merck, while Intel, Salesforce, and Boeing led to the downside. Also after earnings, F5 Networks rose 7%, while Lamb Weston dropped 13%. In other news, Moderna says its manufacturing partners face delays outside the U.S., and wrapping things up, it's a big night for earnings with AMD, Google, Apple, Microsoft, and Visa all reporting after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill Maloney. We've got you covered on earnings, and to hear live breaking news over your Bloomberg, type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. This is Bloomberg.
This is The Big Take, the best of Bloomberg's in-depth original reporting from around the globe.
What we have to make sure we do as the economy recovers is look at the data kind of broken down a bit.
These plants are becoming more and more expensive. You're looking at sort of $15 billion for their entry level.
There have been waves of immigration that have faced a lot of resistance.
There's a lot of color behind the scenes and a great untold story.
How did Bezos really come out on top? As the cover says, Jeff wins. He always seems to win.
The Big Take on Bloomberg Radio.
So the Bloomberg Big Take today, our exclusive story you need to know about, a story by Bloomberg's James Payton and Bob Langreth, who report on how COVID is delivering an unsettling reality check to our world. It's something I feel like we've been talking about a lot on this Tuesday. Let's get to it.
Drew Armstrong is senior editor for U.S. Healthcare for Bloomberg News. He's on the phone from New York City. Drew, I got to tell you, the timing of this is perfect. We just heard from CDC Director Rochelle Walensky about changing mask guidance from the CDC. This is an evolving situation, and the unsettling reality check that we're seeing is really partly thanks to the Delta variant.
Yeah, I was actually just listening to the CDC press conference before I got on the phone with you guys, and one of the things that they mentioned specifically is that there are indications in some ways that this variant is different in meaningful respects, particularly with regards to breakthrough cases and the possibility that people who have been vaccinated and have a breakthrough infection can go and transmit that virus to others in certain cases.
You know, it's such an interesting day. Tim and I, Drew, to be quite honest, we're talking about the funk that we're in because here we are seeing it feels like I've seen this movie before. I don't like it. It's not a good one, but it does feel like we're in a different position. Tim, what? You look like you're going to say something.
It does. I mean, like, I want to know what Drew thinks of this because, look, Drew, you and I have known each other for years. You know, I have a young kid at home. I see news like this today. I read what happened this week, and I think to myself, wait a second, now I'm going to wear a mask wherever I go because I have a 2.5-year-old who's not vaccinated.
Yeah, that's right. I mean, it I think is causing a lot of people to really reconsider what their risk appetite is right now. I think I'll also say that CDC did remind everybody, and the data does seem to bear this out, that almost all of the transmission that's happening right now is happening amongst unvaccinated people, not with vaccinated people. I think the bigger thing that's going on right now, and this is the point of the story that we have out today, is that this is not a virus. It's becoming increasingly obvious that it's just going to be, smashed into submission by rich countries and never had to worry about again. We are looking at what the long endemic tail of this virus looks like, which is going to be, new hotspots in places that haven't been vaccinated, flare-ups like the ones we're seeing in places that have vaccinated with kind of uncertain consequences, and probably some ongoing concerns about these types of variants.
Right, the long tail wins. So how should we as a society, a global society, Drew, it's a global pandemic, as borders open or not, I mean, should we be concerned, or that's part of this long tailwind? We will see reopenings. We can travel if you're vaccinated, but we're still going to have hot spots, especially for those who don't have access to vaccines like some of the developed markets, and certainly not like the United States.
Yeah, that's exactly right. I mean, one of the things that we see people worry about right now in particular is this kind of, two-speed recovery. From an economic standpoint, that's quite problematic. I think we've seen increasing amounts of evidence that, that developed, wealthier nations are going to do much better out of this than places that still really have barely even gotten vaccination off the ground. And that means, throughout Africa, some places in the Asia Pacific, and those places are really being left behind in this, and that has ripple effects throughout the global economy. I mean, the IMF, today is actually out with their latest global growth estimate, saying that they're estimating that growth is going to stay at 6%, but within that they changed things to basically say that it's going to help the wealthier nation. The wealthier nation is going to have a faster recovery than some of the less wealthy nations, and that's primarily because of vaccination.
Well, I think about Peter Atwater over at William & Mary, who we've talked about the K-shaped recovery, but this whole idea, too, of a V-shaped recovery. We've seen this with corporate earnings bouncing off because it was such a mess. Now we're talking, Tim, about a W-shaped recovery.
Yeah, I was surprised to see that in this piece. Drew, take us into the history here, because one of the ways that the piece ends, or the way the piece ends, is it takes us back a century to the pandemic of 1919 and 1918. And I'm wondering if we can see a parallel there with the disease becoming endemic and seasonal the same way that the flu has since then.
Yeah, I think there are some meaningful parallels to the 1918 flu pandemic and some ones that are less useful. I think the biggest point, and there's a great book out there about this that I'd recommend to people, but is that this thing kind of moves in waves, and being spared kind of the first wave, sometimes it means you did things right, but it might also mean you were just lucky. I mean, we're seeing places now, over the last few months that did not get hit badly or as badly in 2020. And there's a lot of ink spilled on, have they figured out the secret?
Right.
Is there something about these societies, be they India, or Sweden? And, we read this, I think we all read these things and,
right.
And said, and wondered, what are they doing right? And then now they've been through some, through some terrible times with this stuff.
Drew, really quick, 15 seconds. China, they did stamp it out. Now they're problematic. Just 10 seconds. What do we take away from that?
Yeah, the locked borders, and they still haven't reopened. It's still, their society is still deeply changed by this virus.
Drew, we always turn to you when we want to know the latest and greatest and just get the best information. Our Drew Armstrong on Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's that time, Carol.
What? Are you ready?
Yeah, no.
Oh,
It's not going to be the Clash. Nope, Dave shook his head. Not going to be the Clash.
All right, I'm looking forward to it. I could use some music to kind of change my mood.
Yeah, I hope it's one that puts us into a good mood.
We got
All
the
things
beat,
chill ahead of this big earnings day, right?
Vacation. Okay.
Maybe
All
it's
right.
Carol.
First, let's get to Charlie Pellet, who's
Save
just
us, Charlie.
saying, Carol, Tim, it's about tech earnings today.
Indeed it is. What can I say? All about Apple, Microsoft, Alphabet after the bell. 28 minutes to go. Equities turning lower today. Mega cap tech stocks tumbling ahead of their earnings reports due out after the market close, and we'll be all over those numbers as they break. Right now, Apple down 1.6%, Alphabet down 2.2%, Microsoft down by 1%. Speaking of earnings, so we do have GE shares up by 1.4%. UPS didn't deliver this morning, shares down by 7.1%. Here's where we stand. S&P down 30, a drop of 0.7%. The Dow down 146, down 0.4. NASDAQ down 206, a drop there of 1.4%. 10-year up 16.30 seconds, 10-year yield 1.23%. Gold is up 0.1%, 1.800 the ounce. West Texas Intermediate crude down 0.2%, 71.74 a barrel. Health officials have returned to tighter guidelines for the use of masks, advising that fully vaccinated individuals wear them in public indoor settings in places where the virus is spreading rapidly. Centers for Disease Control and Prevention Director Rochelle Walensky says recent data gathered by the agency suggests that some vaccinated people infected with the Delta variant can transmit the virus to others. Meanwhile, as a resurgence in COVID-19 cases prompts more American employers to require vaccinations, workers who object are now facing a common response, and that is get a shot or get another job. Dr. Ramesh Adalja is senior scholar at the Johns Hopkins Center for Health Security.
I think the VA steps yesterday, as well as other organizations, are going to make it the norm that healthcare workers should be vaccinated. And I think that's what it should be, because it's a professional obligation. And I was one of the first people to get vaccinated the minute I could before Christmas.
The Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Among some of the vaccine stocks that we track, Pfizer up 0.7%. Its German partner, the ADRs, down 0.9%. ADRs of AstraZeneca up 1.2%. Moderna's up by down 1.9% right now. J&J is up by 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. This is Bloomberg. Bare Naked Ladies, 1 week.
Did it.
Wow. Did everybody hear that? Can we get a recording of that?
Tim gets one.
You know, I figured this song would be in your wheelhouse somehow.
That's
I don't
great.
know what that means. Music
Well, it's my
has
vintage,
no
my
age.
era.
Oh,
Yeah, I think it's my vintage, my era.
Yeah, but we've had this discussion before.
Do you
Carol.
listen to-
People tend to gravitate to the music that comes out, when they grow up.
Do you listen to Billie Holiday?
No, maybe not really.
Ella Fitzgerald?
I'm more of a rock guy than a jazz guy, though.
I know,
appreciate.
but rock is, the
I
basis of
understand
rock
all
is
that.
blues and jazz.
Yes, this is all true, no question.
So let's talk about this chart, because I love this chart.
Let's talk about it. This is the 1 week when you get Apple, Microsoft,
Deluge.
Google's owner Alphabet, Facebook, and Amazon. The first three coming out after the close, as we've discussed at length, and Facebook tomorrow and Amazon Thursday. So Carter Worth over at Cornerstone Macro went back and looked at weeks like this week in the past when you had all 5 of these companies reporting results. It turns out there have been 5 occasions when they have done so. If you look at the S&P 500's performance during those weeks, you will find it hasn't been all that great. You know, 3 of the 5, you saw the index fall for the week. The extreme case was a bit more than 5.5% last October. And in the other 2, you know, basically the index didn't go much of anywhere. In April, it was up 0.02%. So as much focus as there is on these companies' results, and rightfully so, considering how much market value they represent and how well they've done this year as a group, it doesn't necessarily mean that you're going to get, you know, a broader market advance for the week. And in fact, you know, you've seen the S&P 500 kind of stumble around between yesterday and today, not a whole lot of direction. So the question becomes, will these companies kind of pick things up? You have to wonder based on the history. It's really that straightforward.
It does feel like there is always high expectations for these companies. They tend to trade at pretty lofty valuations, I would say.
I mean, look at Alphabet, for example, the parent company of Google.
Right.
Going into today, higher by 50% just this year. The best performer of companies that are valued above $1 trillion.
And then you go through the numbers in terms of what analysts are anticipating for their second quarter. They're looking for earnings to more than double and revenue to be up 46%. That's a lot to live up to.
Exactly.
So I suppose it's really a matter of expectations as much as anything with these stocks.
The comparisons on all of these puppies, these 5 big tech companies, is it pretty easy compared to a year ago, right? Or not necessarily?
Not necessarily,
a lot
because
them
of
were
course,
doing okay.
that's right. And you know, since you're talking about online businesses, really, it's not like they suffered the way that a whole lot of other companies suffered because of the pandemic.
Well,
in any case,
they did pull back. You know, advertisers did pull back, and that's why we've seen some great results from Snap and Twitter. And the base is
true. I mean, but you know, think about, say, relative to the airlines and cruise lines, it's sort of a different magnitude.
Google
in any
was
case,
up 31% last year.
Yeah.
I know. Go ahead. Try to get a word in edgewise.
Exactly. So am I. You know, if you want to see the chart and the explanation that goes with it and everything I do going forward, the email address you can send to request that is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
Stock of the day, Dave?
Be a company called U.S. Physical Therapy.
Ticker?
Yeah, the ticker on this one is USPH. Now, evidently yesterday, one of its rivals, ATI Physical Therapy, came out with results. The shares fell like 43%. You know, there was real concern about labor issues.
Yeah.
I mean, having to pay up for therapists and maybe not having as many people on staff as you wanted. Well, you know, early today, the company came out with, you know, a statement to regulators. And among other things, they noted that they actually paid less as a percentage of revenue for salaries and related labor costs in the second quarter than they did in the first quarter. And that was just what people wanted to hear. And as a result, you have U.S. Physical Therapy up more than 18%, headed for its biggest gain since November.
Look for Dave's Stock of the Day just after 4:15 p.m. Wall Street time on Facebook, LinkedIn, and on Twitter @TheOneDave.
Did your mood change because of the song?
Yeah, I got it right.
A little bit?
It's an uplifting song. I love it.
Dave Wilson, have a good night. Thank you so much.
Let's get a check of world and national news with Nancy Lyons in D.C. Hey there, Nance.
Hey, Tim. The spread of the Delta variant of the coronavirus is prompting health officials to rethink their guidance. CDC Director Rochelle Walensky says it's time to mask up again.
In areas with substantial and high transmission, masks in public, indoor settings to help prevent the spread of the Delta variant and protect others. This includes schools.
Walensky says new scientific evidence indicates vaccinated people are able to spread the Delta variant to others, prompting the need for a mask. The House committee created to investigate the January 6th invasion of the U.S. Capitol has been hearing harrowing testimony today from 4 police officers who fought to protect Congress that day.
Officer Michael Fanone said it was brutal hand-to-hand combat against a mob armed with a variety of weapons.
I had been beaten unconscious. Doctors told me that I had suffered a heart attack, the concussion, a traumatic brain injury, and post-traumatic stress disorder. But nothing, truly nothing, has prepared me to address those elected members of our government who continued to deny the events of that day.
The officers described the signs and flags proclaiming loyalty to President Trump, and they called the invaders terrorists. In Washington, Irv Chapman, Bloomberg Radio.
American gymnast Simone Biles says she pulled out of the team event at the Olympics today because she was not in the right place mentally to perform the skills needed. She did not say whether she'll compete in the all-around final or any of the individual competitions. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, we've heard this song before. Just like dozens of other overwhelmed industries in the booming economy, there are a number of factors causing shortages and price spikes when it comes to the seafood industry.
No crabs, no scallops. Seafood is vanishing from menus in the U.S. This one by our own Adam Jackson and Kate Crater, among the most read. And also, Carol, I saw a lot of people tweeting about this earlier today. For restaurants across the U.S., the reopening from COVID lockdown has been anything but easy. They've struggled to hire back enough waiters and chefs. They've also been rocked by cost increases on all kinds of items and a jump in seafood prices, part of the broader inflationary surge working its way through the U.S. economy, only further squeezing restaurateurs when they were supposed to be raking in cash as the economy recovers.
Back in mid-June, we had the Get Maine Lobster founder and CEO Mark Morell on, and he talked about the pandemic's impact on the lobster industry, specifically talked about $34 lobster rolls and just trying to get access. And what was interesting, they are an online seller, distributor, and they were really busy during the pandemic. People were buying a lot of, just like we were all buying a lot of food online, they were buying a lot of lobster. But for the seafood industry, as you said, whether it's ports being congested, there's not enough fishermen around, and so we're seeing pretty dramatic price spikes. Seafood prices rose about 11% in the 12 months through early July from the previous period, according to Nielsen IQ. Stretch out the time horizon a little bit, and the increase on certain hard-to-find products are much starker. A pound of halibut goes for $28 from the local seafood distributor he buys from Atlanta. This is one individual. Before the pandemic, it was about $16 at most.
Wow.
Blue crab has gone from $18 a pound to $44.
Yeah, but at least he can find crab, because in Orlando, Brennan Heretic, the co-owner of High Tide Harry's, had to stop selling crab fingers because wholesalers in the region stopped offering them. Any questions to Jay Powell tomorrow about seafood prices?
Mike McKee, where are you? Mr. Chairman,
But
I have a question.
Maybe, though, about food.
Well, that speaks to, again, transitory or not.
Right.
When you figure out these port congestion problems, when you figure out there are enough fishermen back, do these prices settle down?
That's the question.
It is the question. Maybe Mike will ask that of Jay.
Yeah, that's an expensive halibut.
Yeah, it's very expensive. This is Bloomberg. Eat chicken, I guess.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Tech Tuesday, 13 minutes to go ahead of the closing bell. 13 minutes to go until we hear from the likes of Apple, Microsoft, and Alphabet. All three trading lower right now. Apple down ahead of earnings, down 1.8%. Alphabet down 2.3%. Microsoft down by 0.9%. We'll have all those numbers as they break coming up again just about 13 minutes from now. Equities lower ahead of those mega cap earnings. We have got the S&P down 28 points, lower by about 0.7%. The Dow now down 130 points, down by 0.4. NASDAQ down 210, a drop of 1.4%. 10-year up 16.30 seconds, 10-year yield 1.23%. We've got gold up 0.1%. 1,800 even now on the precious metal. West Texas Intermediate crude down 0.3%, 71.72 a barrel. So again, recapping ahead of tech earnings, stocks lower, S&P down 0.6%. NASDAQ 100 index tumbling 1.3%. And that's a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just about 10.5 minutes left in today's trading session. I'm kind of setting up my 4 screens of the Bloomberg terminal so that I can track the dump of earnings that we're going to get from big tech names, Tim, in
Microsoft,
just a few minutes.
Alphabet, Apple, all set to report, among many others. Starbucks, too.
These are big ones.
AMG.
They have provided a lot of momentum, certainly to the trade over the last year or so. Let's see what Hillary Kramer has to say when it comes to today's market trade and those earnings yet to come. Hillary Kramer is President and Chief Investment Officer at A&G Capital Research, author of Game Changer Investing, How to Profit from Tomorrow's Billion-Dollar Trend. She's on the phone in New York City. Good to have you back with us. What's on your radar today? Because we've talked a lot about big tech earnings, Chinese oversight, Chinese big tech selling off. We've talked about the Delta variant. What really matters to the equity trade in your view?
Well,
all of the above is okay, too.
Carol, it's everything that you mentioned, but the market's very nervous here for sure, and that's what those variants are. But you have China. The valuations are high and overstretched, but then we have these brutal sell-offs, right? With these sharp sell-offs, and then everyone gets kind of shaken out, and then and then everyone comes back in. But I really do think that COVID with the Delta variant is an issue. The Fed stopping with tapering could really be a concern because next could be, raising rates. And no one's really talking about taxes and a $3.5 trillion infrastructure deal, a human infrastructure deal that needs to be paid for. And that's concerning everybody from the far left to the far right. Ordinarily it's something that, we all want and we recognize the importance. But when you're talking $3.5 trillion, the market's very nervous. Now, in terms of specifics, Carol, Apple is tricky. Let's talk about earnings like in a few minutes from now. What's on my radar?
Yeah. That's on our radar too, Hillary.
Apple is really tricky because 5G, I think, is already built in. Apple's not a top-line grower. They don't have all that cash that they used to have. Everyone thinks of Apple as rich in cash, but they've bought back so much stock. And then I was looking today at the operating income. In 2016, Apple's operating income was $69 billion. Last year it was $77 billion. It is not a big growing company. I do think Microsoft is going to be great. I think they just continue, on all cylinders to grow, and everything from gaming to their web services and cloud computing. So they're very strong, and so that's really what's on the radar. My other concern, of course, is what we're going to hear in terms of, for example, Caterpillar on Friday, reporting. We have Ford. Now, Ford doesn't matter a lot, but Ford on Wednesday is going to matter to me because we want to hear what Ford has to say to the minute about difficulty with the supply chain.
Yeah.
Right? You know, we keep hearing this. Everyone knows semiconductors are a problem, but what
Elon Musk was okay. I guess you just have to do it all yourself, huh?
Well, you have. The problem is that's just it. Nobody really can, and I think that one of the reasons we see a lot of these engineering and infrastructure companies not really like catching a bid, even with a $1.5 trillion, you know, like actual infrastructure coming. That's not the human infrastructure bill that we're going to see, but the concern is how are they going to really be able to build? You know, they're really backed up because of that, and so what I am advising and what we're writing about is that we think that the banks, you know, there's this sort of built-in expectation of recession, so we think the banks are the best opportunity here, and the banks are also a great proxy for having bonds.
Hillary, I want to go back to something that you saed a couple minutes ago with regard to the Delta variant. Did you say that it is of a concern or is not a concern for markets right now?
It's becoming a yawn, right? It's not as much of a concern as it had been. However, it's the kind of thing that can bite us, you know, that can just, you know, get us really quick, and especially when you see the numbers and how fast COVID can spread.
Why is it a yawn if the CDC is changing its guidance? If we saw the sell-off a week ago Monday, the narrative around that was because of concerns about the Delta variant. Why is it a yawn to you?
Because the market worries about the unknown. What it absolutely doesn't understand that could hit it, you know, like, you know, a chair, like you can hit over the head. The stock market worries, but everyone has sort of this built-in expectation. We're no longer in March, April of 2020 where we're wearing, you know, 2 pairs of gloves and we're stripping down when we get home. The concept now is, okay, COVID is bad. Now, I'm saying what the sentiment is. In my opinion, living in New York City, Midtown Manhattan, across from NYU Medical Center, Langone, I can tell you it is real. It was real. I saw dozens of, you know, medical examiner trucks, you know, refrigerated morgues, and it's real. But the market isn't really paying attention to it. Instead, the market's more concerned really about China right now, which should, I think, be the least of our concerns, except if we have a lot of investments or some of the funds that are highly invested in China.
So you're not so, but wait, so explain that. What does our audience, I mean, we've talked about that a lot in the last couple of days and certainly this week and over the last couple of weeks. And I really, it's going to be when we get to December of 2021, this is going to be one of our big stories of the year. No doubt about it. What is it that our audience needs to continue to pay attention to when it comes to China?
That it has to do with really more the Cathy Wood type funds, the funds that are...
She's getting out of Chinese tech companies.
I know, I saw that. So she's starting to dump and leave those. Why would she do that? Because she sees that her return, her alpha is slipping because of China, and that's where one needs to be concerned. To me, it reminds me of like the year 2000 with internet stocks starting to fall, but the greater market really didn't have much concern. At the same time, though, of course, you know, there could be some spillover, but these Chinese stocks, right, Alibaba keeps hitting 52-week lows.
Is Alibaba a bargain right now?
I don't think so. At this point, I wouldn't touch it because we don't really know exactly what's happening in China, but we have enough strength and understanding and transparency in the U.S. market that we don't have to really worry that. I'm not really focused on China. I mean, again, my big concern is inflation. My big concern is we have these unemployment benefits that are expiring, the last of them September 3rd. So you have unemployment and you have this extra $300, which some, I know, states have already eradicated. But, you know, we could see that could be the big tipping point.
Hey, listen, I want to jump in because we're running out of time. But one of the things you say is avoid big tech until after earnings. These stocks will get cheaper. If you say you're worried about a bubble, this is where the bubble is. But potentially there could be some opportunities after we get this dump of big tech earnings.
Yes, and the reason is simply that people go back into it. So it's almost...
They always do, right?
It's always more of a trade at this point, but you're looking at valuations that are overstretched. But at the same time, I will say Apple is trading at 28 times next year's earnings, you know,
right.
$5.34. That still isn't horrible, but Microsoft, which I love, and I think that they're going to be the one that we're going to see up, you know, in after market trading tomorrow morning. We're going to see up. It's Microsoft. I never thought I would see it at trading at 34 times June 2022 earnings.
Right.
So,
yeah.
So, Carol, it's a worry. It's a concern.
Got it.
We all have forgotten the fact that these were stocks that were all trading below $100. And that are
so very
it's
very different.
Overstretched. Everyone's looking for yield. Everyone's looking for return. There's too much liquidity out there. The Fed has done us absolutely no favors. They've made billionaires out of some.
Got it.
And there are lots of people that don't have it. So,
Hillary, we've got to run, but thank you so much. You covered so much ground like you always do. Hillary Kramer, she's over at A&G Capital Research, joining us on the phone. All right, everybody, coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell on Bloomberg Radio, Bloomberg TV, and YouTube, counting you down to the close on this Tuesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Boston, Caroline Hyde, Taylor Riggs, counting you down to the closing bell, here to help take us beyond the bell. Our global simulcast, joined right now by Carol Master and Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences. And it's all about earnings. Carol, break out the fire hose.
Oh, my God. I've got like my 4 screens of Bloomberg just kind of on different companies, whether it's Microsoft, whether it's Apple. I mean, this whole week is all about the big tech names. Will they live up to the expectations? They've often provided a lot of momentum, but as of late, when they all tend to report in the same week, Dave Wilson talked about this, we often see a drag down in the overall broader trade in the S&P, Tim.
Well, it's certainly what we saw today, a story of mega cap tech stocks bringing down the overall market. We're talking Apple, Microsoft, Alphabet. All of those companies set to report in just a few minutes. Caroline, Class A shares of Alphabet, the parent company of Google, down more than 1.7%. Those declines leading the NASDAQ to what could be its worst one-day drop in more than 2 months, Caroline.
Yeah, since mid-May. I mean, we're off by 1.25% on the NASDAQ. Volumes looking pretty steady from where they are usually, but this is a story of companies in general beating on earnings. And if Snap and Twitter were anything to go by last week, the advertising commitment is really there. It's the forward-looking guidance for the next quarter that's going to be so important.
And dare I say it, Caroline, can we bring it back to yields? I don't know if we can. For so long, lower yields meant such a boost to some of these big tech companies. Unfortunately, I think, Romaine, we're in this period where these lower yields are actually giving a signal of maybe slower growth in the future. And so that's not giving us a boost to the equity markets the way that we were maybe a few basis points higher.
Yeah, and of course, this comes against the backdrop of that Fed meeting tomorrow. And of course, a peek at that second quarter GDP data. Let's get you really quickly here through the closing bell numbers. 35,063 on the Dow Jones Industrial Average. That's down about 82 points, 0.2%. S&P 500 down about 21 points, or about 0.5%. The NASDAQ Composite having a pretty bad day here, down 180 points, more than 1% here, loss on the day. And the Russell 2000, that's down about 1.1% here on the day, Carol, as we await these earnings.
Right, as they will start to cross any moment. The point is, though, we did finish off our lows of the day, so we were able to see investors come in, do some buying as we saw those dips. It's a trade that we have seen, Taylor, over and over again.
Let's take a look at some of the sector action as we're waiting those earnings, green and red for our gainers and our losers. Really, this does come back, Carol, to a bond story. I hate to say it. Utilities, real estate, food and beverage. You're getting hint of defensiveness with telecom. For the radio audience, you're up anywhere from 0.2% to 1.5% as you saw yields come down about 5 basis points across the curve. You go to some of the losers as well, and it's retail, it's auto, it's semiconductors, it's transportations. Caroline, you're really getting this sense perhaps that it's some rotation out of these big transportation stocks as we're hinting at some supply chain concerns, some of that inflationary, some of those wage pressure concerns as well.
And also, we've got plenty of concerns surrounding the investor base at the moment, whether it be the Delta variant, of course, more CDC guidance coming out for certain states, corporate action, Ford reimposing mask mandates potentially over in Florida and Missouri. But also, there's an element of the China concern remain. This has been really where the moon music went from the very start of trade.
Microsoft earnings crossing the wire right now. Those 4Q numbers coming in right now, their revenue numbers, $46.2 billion. That's above what the street was looking for. The street was looking on average for about 44.26. The EPS number, 217. That's also a beat here. The street was looking for 192 here. Again, these are for your fiscal Q4 for Microsoft. Here's your personal computing numbers. The number a lot of people are looking at, $14.09 billion. That's above what the street was looking for. Productivity revenue coming in at about 14.7, guys. And finally, the intelligent cloud business coming in at 17.38 billion. So on the surface here, pretty much a beat, at least on all the top line numbers.
Well, and check this. We always want to know what companies are doing with their money. Are they doing buybacks,
Yeah.
dividend increases, or are they investing in the company? Microsoft returning $10.4 billion in the form of share repurchases, Tim. So that's where we're seeing a lot of companies. That's what they're doing with their excess cash. Investors like it, but what does it do for the long-term strategy?
Yeah, let's go through some of these numbers again. Microsoft fourth quarter revenue, $46.15 billion, beating estimates on the top line of $44.26 billion. The company's saying it will provide forward-looking guidance on its conference call, which will be welcome news to investors who haven't necessarily in other companies heard this quarter from companies that are willing to give that guidance. And as Carol mentioned, the company returning $10.4 billion in the form of share repurchases.
This is a company that doesn't have a single sell rating on it, I might add, and of course reached that $2 trillion market valuation. So a company that continues to reorientate itself. Satya Nadella can do no wrong, really, when it comes to the focus on the cloud, managing to really give Amazon a run for its money when it comes to the cloud computing focus, but also just our new... The question is whether things were brought forward, whether us now working in this hybrid model when we're turning to Teams, Microsoft Teams, and some of the productivity that they offer, whether that continues to grow. LinkedIn, that purchase they made, still clearly reaping some dividends, Romain.
These capital expenditure numbers, Taylor, coming in at $6.45 billion. The street was looking for a little bit less than that, $5.4 billion. You're wondering whether that's a positive sign or a negative sign. Right now, you see the knee-jerk reaction on your screen, 1.84% down.
Well, you get a little nervous when some of the CapEx is lighter. They're choosing to buy back shares, which means management certainly thinks that the shares are undervalued or there's no better use of cash, Carol. And so we're certainly looking at a company with, what, $125 billion in cash on the balance sheet. I'm locked out of the press release. They've said no. Taylor Riggs is not getting in.
You have to do the next one.
She keeps passing
there's a
those
different link.
chartered financial tests, and we don't want her to see it. What's interesting, though, is to see that stock, it's bouncing around, down about 1.6% in the after hours. But this is a discussion that we have with a lot of market players. I know you guys do as well. As do they live up to the expectations, that we have seen? Is certainly when you look at some of the valuations of these companies. For Microsoft, the expectations were high because we've seen some nice numbers in terms of growth when it comes to web services. In gaming, we just had a guest on who was talking about and expecting a lot out of this company. You've got a PE, Tim, of 39, forward-looking of 34, and you've got to see a company, really meet or beat when it comes to some of that.
And we should point out, this is a stock that had already rallied, Tim, about 28% heading into earnings.
Right. Hey, nothing compared to Google rallying 50% heading into earnings that we're waiting on the parent company of Alphabet. We are getting some commentary from CEO of Microsoft and Chairman Satya Nadella, quote, "We are innovating across the technology stack to help organizations drive new levels of tech industry across their business. Our results show that when we execute well and meet customers' needs in differentiated ways in large and growing markets, we generate growth, as we've seen in our commercial cloud and in new franchises we've built, including gaming, security, and LinkedIn, all of which surpassed $10 billion in annual revenue over the last 3 years."
All right, let's go to Starbucks. Third quarter comp sales, always important when it comes to this company, up 73%. So that is a beat, folks. 69.6 was what folks were expecting. Third quarter international comp sales. We like to look at this company because they're all over the world. Gives us an idea of what's going on with global consumers. Third quarter international comp sales up 41%. That is a miss. Estimate was for 58.6%. In the Americas, that comp sales number up 84%. That's a beat. Up 73.4 was the estimate. And let's get to the adjusted EPS. $1.01. That's a beat. The estimate was for 78 cents a share. So we're seeing that stock. Just take a look here in the after hours, just up about 0.8%, Caroline.
Meanwhile, let's talk toys, because we had Hasbro, of course, knocking it out of the park just a couple of days ago. Mattel, the maker of Barbie, you know it. Second quarter loss actually better than had been expected. Their adjusted earnings per share, 3 cents. The anticipation was for a loss of 6 cents. They're seeing second quarter sales in excess of $1 billion. The CEO saying there's another exceptional quarter for Mattel. This is a company that's pivoting to growth, a focus on IP, a focus on not just the world of toys in reality, but also on gaming, whether it be in licensing to TV and to overall films. The overall performance, they say, comprehensive top-line growth. So a beat for Mattel, Romain.
What I really want to hear out of Mattel, though, is some of their commentary on the supply chain issues. We had the Hasbro CEO on early this week. He seemed to shrug that off, saying that they were doing fine. Of course, we're going to get Apple a little bit later today. The supply chain, of course, Apple very sort of intertwined with what's going on overseas in China and elsewhere. So it'll be interesting to see whether those issues are affecting any of those production pipelines, guys.
Well, and further, how much are they passing on those costs to the consumer? Carol, we were certainly speaking with the Hasbro CEO yesterday and hinted that 10% perhaps maybe was too high of a price increase, but they're doing enough just to cover their costs. So they're certainly seeing those costs. They're passing them on to the consumer, but they're not doing more than that. They're doing just enough, and you wonder if that does indeed give a read-through to Mattel as well.
Well, what's so important about all of these companies is what it tells us about maybe also the progression or lack thereof in terms of the virus. And I'm looking at Starbucks third quarter China comp sales up 19%. That's a pretty big miss. The estimate was for 32.5%. Starbucks China specifically, I feel like it's been a smart indicator of where we are in the virus and economic reopenings. And so we watch this very carefully to see of maybe where things are going or whether or not we're starting to see economic shutdowns again, Tim.
Yeah, I mean, that's the really important thing to keep an eye on. I mean, Starbucks top line so solid compared to a year ago because remember where we were in the second quarter a year ago going into the third quarter, right? We were coming off of lockdowns around the world. And again, looking outside of the United States, looking to China to see how the company has been doing over there as some sort of key indicator, Romaine, to where the United States potentially will be, though it is harder and harder to find parallels.
Yeah, exactly.
Yeah, and it'll be interesting to see how we aggregate all this together and see how it affects the market. Of course, I mean, just the 3 or 4 big companies alone, you're talking about 16% of the S&P 500. And right now, most of these stocks are in the red, despite some of the beats. Microsoft, Starbucks, AMD, which we haven't gotten yet. Alphabet, Caroline, also in the red.
Yeah, we're going to wait on the Google nitty-gritty. Interesting that, of course, Mattel, the toy maker, were raising their guidance, continuing to improve profitability. But they, too, Carol, mentioned about the risks surrounding COVID. This is a company that produces a lot over in Asia. They say the top priority continues to be health, the safety of its people, and they remain mindful of the volatility that COVID-19 has brought and the macroeconomic uncertainties, of course, that being, to a large extent, Taylor, the supply chain issues that we're likely to see, the cost in terms of shipping, and indeed how that feeds through to the consumer.
And the supply chain issues, at least when it comes to Starbucks, not getting a clear indication, but talking about an improvement in the operating margin due to, well, of course, some of the easy comps from the year-over-year numbers, but pricing and benefits offset by increases in some of the wages and increased supply chain costs due to some of these inflationary pressures. So we're counting how many times we hear that in CEO calls.
And you got to wonder how Jay Powell adds it all up in the FOMC when they finally give us that decision tomorrow. All right, busy Tuesday
Don't you love
afternoon.
this time of year?
I do. It's like Christmas, but in the earnings version. All right, that's going to do it for our cross-platform coverage on radio, TV, and YouTube. We'll see you again tomorrow, same time, same place. Let's get a check on world and national news. For that, we're going to turn things over to Nancy Lyons in D.C. Hey, Nance.
Hey, Carol. The CDC is updating its mask guidance, saying those who are fully vaccinated in coronavirus hotspots need to wear masks in indoor public settings. Dr. Rochelle Walensky says it's due to the rapid spread of the Delta variant.
Some vaccinated people infected with the Delta variant after vaccination may be contagious and spread the virus to others. This new science is worrisome and unfortunately warrants an update to our recommendations.
Walensky says mask wearing is encouraged in areas where those cases are rising, as well as in schools this fall. Lawrence Gostin is an advisor to the World Health Organization and a public health law professor at Georgetown University. He says the changing guidance is head-spinning.
I'm afraid that with these third set of recommendations now, it's going to be hard to put the genie back in the bottle. You know, people have taken off their masks, and I can't see people masking up.
You can hear more with Gostin on Bloomberg Sound On at 5 p.m. Wall Street time, right here on Bloomberg Radio. Emotional testimony today on Capitol Hill from several officers who beat back the mob during the January 6th attack on the Capitol. D.C. Metropolitan Police Officer Michael Fanone says he cheated death that day.
I was aware enough to recognize I was at risk of being stripped of and killed with my own firearm. I was electrocuted again and again and again with a taser.
Fanone's doctors say he suffered a heart attack. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Carol.
Thanks so much, Nancy. Let's get a check on how the trading day ended up with Charlie Pellet. Hey there, Charlie.
Well, hello there. It was a down day with the Dow, the S&P, NASDAQ all lower. We're keeping tabs on earnings. Still awaiting the numbers, the latest numbers out of both Alphabet and Apple. Microsoft, though, did report record revenue for the fourth quarter. It beat the average analyst estimate. Microsoft's fourth quarter revenue, $46.15 billion. Estimates there, $44.26 billion. Starbucks reported comparable sales for the third quarter that did beat the average analyst estimate. The Dow, the S&P, NASDAQ all lower today, with equities ending a 5-day winning streak as mega-cap tech stocks tumbled ahead of their earnings reports. S&P down 20, a drop there of 0.5%. NASDAQ down 180, a drop there of just about 1.2%. Dow Industrials down 85, a decline of 0.2%. 10-year yield 1.23%. Gold up 0.1%, 1,800 the ounce. West Texas Intermediate crude down 0.1%, 71.80 a barrel. So again, fourth quarter revenue beat out of Microsoft as we await the latest numbers from Alphabet and Apple. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So Alphabet typically releases its earnings right on time. It is now 8-9 minutes late, so we are glued to the Bloomberg terminal. So too is our Bloomberg Intelligence Senior Technology Analyst, Mandeep Singh. He's actually glued to his phone, waiting for those Google numbers to come out. What's going to be key here? The shares were down 1.6% at the close. What do we need to be focusing on here, Mandeep?
I would say YouTube and cloud. I mean, those are the growth drivers for the company going forward. We know the search business is going to go very well simply because the ad spending environment is so strong. We saw that in the results of Snap and Twitter last week, so you're going to see the same with Alphabet.
Okay, let's talk cloud because
it's coming out.
It's coming out. Okay,
yeah.
Carol, you get to those. I'm going to be looking closely at cloud. I'm going to let you both work on.
Well, let's just do second quarter Google Cloud operating loss $591 million versus an estimated loss of $1.3 billion. Second quarter EPS 27.26. Shoot, the numbers are coming so fast. They're flipping on my Bloomberg terminal. Second quarter EPS 27.26. The estimate was for $19.35 a share. Second quarter revenue $61.88 billion. That's a big beat. $56.23 billion. That's a big number, Mandeep.
It is, and looks like all the segments did very well, including core search, which we think over time will slow down simply because the law of large numbers will catch up and search relevance is somewhat going down on mobile. But YouTube, cloud, I mean, these are really the growth drivers, and looks like they did very well across the segments.
Stocks down about 0.25%, down 0.4% here in the after hours. So Tim, just down a little bit.
Yeah, let's go through some of these numbers. Second quarter revenue, $61.88 billion. Big beat. Estimates were $56.23 billion. Other bets.
Correction, it's up 0.8%. Forgive me. Now
Go
up
ahead.
1% here in the after hours.
Perfect. The company's saying that investments in AI and cloud helping drive improvements. Mandeep, talk a little bit about cloud right now, because Google Cloud Service operating income, or Google Service, I should say, Google Cloud revenue coming in at $4.63 billion, beating estimates of $4.34 billion. It's a relatively small when it comes to the actual cloud space in the United States. AWS and Microsoft absolutely control the space.
Absolutely, and that's what Alphabet is trying to do, is to really diversify their revenue stream here. And they made a lot of management changes when it comes to the cloud division specifically. So those seem to be paying off because they have signed a number of large deals with the likes of Ford. And, basically what they're saying is bring your workloads to the cloud and we will give you an enterprise level support that wasn't there before.
How does that hit margins though?
Yeah, so cloud, and I still have to look, but cloud still seems to have negative margins, so
right.
It was the same this quarter. And look, with cloud, we have seen the script before. AWS and Microsoft Azure have 20-25% operating margin. We think when this business matures, that's where Alphabet will end up. So it wouldn't be a surprise to me that they're investing a lot up front to, drive those large deals.
And Alphabet investments in AI and cloud helping drive improvements. Is it just a case that they're late to the party? Stock, by the way, up 2.6% as we see AMD also crossing sees third quarter revenue $4 to $4.2 billion. That's above the estimate of $3.8 billion. So AMD obviously key to the chip sector. Also coming out, Alphabet second quarter revenue ex-TAC traffic acquisition cost $50.9 $50.95 billion. That's a big beat of $46.08 billion as well. Why were they so late to the party with cloud? Tim and I were talking about this. I mean, obviously, Amazon was way ahead of everybody else. Microsoft played catch up. They're doing well. Google is still playing catch up.
Yeah, so they had execution issues. They really didn't have an enterprise class Salesforce team. So that's where they made the most changes. They brought in somebody from Oracle, and that has made a big difference in the execution.
It's so interesting compared to Microsoft, a company that's been focused on the enterprise for pretty much since its founding, right? Google was a consumer-focused company, especially with its product suite.
And in Google's case, a lot of the cloud was supporting their YouTube infrastructure. So the fact that, YouTube is doing very well is a testament to how good their cloud is.
Well, let's talk about YouTube.
That's a good
because
point.
This was a really, really important quarter for YouTube, for the company. A lot of analysts looking closely and saying, wait a second, with YouTube increasingly available on larger screens in the home, people watching it less on their phones and perhaps more on bigger screens, that's an opportunity for advertisers to reach eyeballs in a different way. What are you seeing in the data?
Well, so it looks like a big beat on the YouTube side. And in my mind, YouTube as a business is growing faster than a combination of Netflix and Spotify. If you were to add their revenue and growth rates, YouTube is actually doing better than both. And it's just a function of the trends. Linear TV ad spending is shifting to connected TV. That's what is reflected in YouTube's numbers here.
And we see it as we watch the streaming and so on. And YouTube ads shot up to $7 billion for the quarter, an 83% yearly jump. Google now up 2.5%.
It doesn't include subscriptions, by the way. That's just the ad revenue. YouTube also has subscriptions.
Our Mark Bergen's writing, after an anemic second quarter last year, Alphabet has come roaring back. Net sales grew a remarkable 61% to $50.95 billion. That's big numbers.
This is phenomenal. I mean, a company of this size, $100 billion plus in annual revenue run rate, growing at 60%. This is just off the charts. And
it's nuts.
It's a broad-based beat. It's not as if, search did very well. It's every segment has done really well here. So I want to call out search simply because that is the cash cow that keeps funding all the businesses.
The OG for Google.
But then search eventually will slow down. Our view is, look, the comps were easy, and you're going to see a slowdown because of the law of large numbers in search.
Mandeep, is other bets something that analysts at all care about? I mean, it is a tiny, tiny category, but it's historically been one of those places that Alphabet has said this is where the next big thing could come from.
So instead of other bets, I would just point to Google Other, which is their Android revenue. So that is one segment which seems to be in line, and our view is Android has a lot of issues when it comes to commissions. The fact that Play Store commissions were in focus and they have been in the regulatory crosshairs.
It's a similar story with Apple.
Yes, so that's one area where I think the results are in line. But the other bets, it's more, their Verily revenue, and they have some, on the payment side, they have a small exposure, but nothing to call out there.
The CEO of Google and Alphabet, Sundar Pichai, saying in the second quarter there was a rising tide of online activity in many parts of the world. We're proud of that our services help so many consumers and businesses. Our long-term investments in AI and Google Cloud are helping us drive significant improvements in everyone's digital experience. You got to run to TV. Just quickly, what's your headline on research tomorrow when you write about Google?
I mean, just phenomenal quarter and really a diversified revenue stream, and looks like a company that's well positioned to ride these trends of online advertising and cloud.
Well, it seems like investors are certainly hearing that because the stock, as we said, up in the after hours. Mandeep, thank you so much. Mandeep Singh, he's our Bloomberg Intelligence Senior Technology Analyst. He's not done. He's going to TV. Then he's going to write research. It's going to be on the terminal. It's amazing.
It is amazing.
Strong.
He's running to TV right now. In the meantime, let's turn to Anurag Rana from Bloomberg Intelligence, who's joining us right now to take us through those Microsoft results. Anurag, what is the headline here?
It's a massive beat across the line. I mean, I don't see anything wrong in the numbers so far. I mean, it's just phenomenal in terms of what they have done compared to what Street was expecting in all the three segments. Total revenue, I mean, gross margins, Azure, adjusted EPS. I mean, you name it. Everything is good.
Why is the stock down 2.3% in the after hours?
I think it's going to be very tough for Microsoft to beat this entire framework for the last 12 months going into next year. So I think that could be there are some fears there that Microsoft may not be able to grow at that same rate of closer to 20% next year. Now, I think, Tech spending is very strong. So we'll figure out whether they can come even close to it over the next year. Now, another area is going to be whether margins are going to hold up, because as you can expect, as the economies open up over the next 12 months, you will see margins trend down a little bit as people spend more on T&E, travel, etc. So that's going to be very interesting for us to figure out.
Okay, so let's go through some of these numbers here. If you're just joining us, Microsoft reporting earnings a few minutes ago. Revenue beating estimates, $46.15 billion for the quarter, beating estimates of $44.26 billion for the quarter. EPS beating estimates of $1.92, coming in at $2.17, so handily beats on the top and bottom line. Productivity and business process revenue, a beat there. Intelligent cloud revenue, a beat there. More personal computing revenue, a beat there. Let's talk about cloud, because when it comes to the biggest players in the industry, Anurag, Microsoft comes in at number 2 behind AWS. What do we know about margins in this intensely competitive space?
So what happens is, currently there is massive margin improvement going in their cloud infrastructure business, and that's going to only get better over the next few years as the business scales up. Now, in cloud infrastructure, where you said these guys are number 2, that's absolutely correct. But when you look at other cloud assets, for example, Office, Dynamics, I mean, these guys have a far better portfolio than I would argue anybody else out there, perhaps except Salesforce.
We're talking with Bloomberg Intelligence Senior Software and IT Services Analyst Anurag Rana, who covers Microsoft for us here at BI. I'm reading a write-through by Ardina Bass and saying that some of the pressure on the stock in the after hours because of concerns over Azure. Sales increased 51% in the period. Some investors hope for a faster rate of growth, especially because that revenue rose 45% when accounting for currency fluctuations, but it's talking about greater competition. Does it worry you?
No, the cloud market is big enough for everybody to be there. Now, if some, hedge funds are not happy about it, I actually don't see any logic behind it, because the market size is so big that for them to grow, above 40% with such a massive base is pretty impressive in my view.
What do we know about how Microsoft has been able to weather the pandemic, the way it's been able to develop Teams as, I don't even want to call it an alternative to Slack, because it does seem like in the IT world, if companies are running Microsoft, they seem more likely to run Teams. But how did the company fare over the last year?
Oh, it's done exceedingly well. Because, one of the biggest things is you do not need to go out and get a special approval if you want to add another, particular product to this thing. Most companies already have Office subscriptions. They already have Word. They already have Excel. And for them to add on another feature, they don't have to cross much hoops. And plus, on top of that, everybody knows the Microsoft products. Now, the other competitor, which is Slack, arguably was a better product a few years ago, and Microsoft has been bridging the gap over the past few years. Now, Salesforce has bought them, and we'll figure out how they share up over the next 12 months, because Salesforce can use their distribution arm to improve the standing of Slack.
Hey, just quickly, Anurag, still down about 2.4% here in the after hours. If, though, Azure starts to slow, is that problematic for Microsoft? Just very quickly, please.
It's not going to make that big of a difference to total top line.
Really? Okay, good to know. And great analysis, what you need to know about Microsoft. Again, that stock down 2.4% in the after hours following earnings, but you heard what Anurag had to say. Anurag Rana with our Bloomberg Intelligence team. He is Senior Software and IT Services Analyst.
Yeah, Microsoft revenue coming in above estimates, bottom line coming in above estimates, operating income beating estimates, CapEx higher than estimates.
It's pretty impressive. We're going to continue tracking those earnings. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
And Apple is out. Stock bouncing around the after hours, mostly higher. It's just, though, up barely, up a fraction of a percent. It was up a full percent a little bit earlier.
Look,
but
expectations are high.
I know, and that's after both a top and bottom line outperformance. We're going to get into all the numbers, but first up, let's get over to Charlie Pellet. Charlie, I know you're tracking Apple as well.
Indeed, keeping a very close eye on Apple. Should point out shares just turned lower, down now by about 0.4%. iPhone revenue, let's begin there, $39.57 billion. Estimates, $34.56 billion. Third quarter revenue, $81.4 billion. Estimates there, $73.82 billion. Apple did maintain the quarterly dividend at 22 cents a share. Apple topping estimates as service revenue hit a record. Also after the bell, number of other key reports. Alphabet reporting profit and revenue for the second quarter that did beat the average analyst estimate. Shares up 1.2% to a record. Microsoft reported sales and profit that exceeded analyst estimates for a 10th straight quarter. Anurag Rana is a senior analyst with Bloomberg Intelligence. You heard him moments ago right here on Bloomberg Business Week.
It's a massive beat across the line. I mean, I don't see anything wrong in the numbers so far. I mean, it's just phenomenal in terms of what they have done compared to what Street was expecting in all the three segments. Total revenue, I mean, gross margins, Azure, adjusted EPS. I mean, you name it. Everything is good.
Investor optimism, however, was tempered by concern about slowing growth in the software giant's Azure cloud computing business. S&P had its worst day in a week. Stocks lower across the board today. Hillary Kramer is president, chief investment officer at A&G Capital, and she says there's no shortage of concerns for investors.
COVID with the Delta variant is an issue. The Fed stopping with tapering could really be a concern because next could be, raising rates. And no one's really talking about taxes and a $3.5 trillion infrastructure deal, human infrastructure deal that needs to be paid for, and that's concerning everybody from the far left to the far right.
S&P down 20, a drop of 0.5. The Dow down 85, down 0.2. Nasdaq down 180, down 1.2%. 10-year yield 1.23%. Gold up 0.1%, $17.99 the ounce. Crude little change, $71.93 a barrel. Again, Apple shares higher now after hours. Apple up 0.5%. Apple topped estimates. Third quarter revenue $81.4 billion. Estimates $73.82 billion. Our tech earnings coverage continues. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Those Apple numbers continuing to come in. As Charlie mentioned, third quarter revenue, $81.4 billion, beating estimates of $73.82 billion. Bottom line, third quarter EPS, $1.30, beating estimates of $1.01. Let's get into some details and really why the stock isn't reacting that much after hours. Joining us is Angelo Zeno, senior equity analyst at CFR8 Research. He joins us on the phone from Long Island, New York. Angelo, it's a beat across the board, yet shares of Apple only higher by 0.5 percentage point in the after hours, now 0.8%. Why such a muted reaction?
Well, to be honest with you, I think it's all about expectations here, and I think as far as the street was concerned, I mean, we all knew it was going to be a very, good quarter, likely going to beat. They beat notably here. I mean, pretty much well above where we had expected the beats to have been. But when you kind of look at where really the biggest beats came from, it was in more of their core hardware businesses, that being kind of iPhone, iPads, Macs. And when you think about those businesses, I mean, you specifically look at, let's say, iPhones growing 50% year over year. That's absolutely phenomenal. But I think the question remains is there some sort of pull-in effect here? How sustainable is this type of demand on the hardware side of things as we kind of go into 2022 and beyond? So I think as they kind of continue to beat and raise here, there's just growing concern on whether that momentum is sustainable.
Yeah, it's like, where's the next big thing? We have talked about that Apple, when it comes to Apple over and over and over, and it's, being so reliant on that iPhone. But we've been talking about that for years, and it's what, a $2 trillion plus market cap company, and they've done just fine. How do we think about that idea of Apple, continuing to diversify, or the need to diversify still beyond the iPhone?
Yeah, and when I start thinking about Apple and the long-term story here, listen, you kind of just have to deal with kind of the noise here on a quarter-in, quarter-out basis on what investors do. But when we start looking at the revenue trajectory here, look at services, about 24% of revenue this quarter grew north of 30%. I mean, it was an absolute phenomenal quarter for services. They're clearly doing something right on that side of things. Wearables as well, growing north of 30% also on that side of things. So, we start thinking about, is there anything else that can kind of drive this company? There clearly is. In fact, when we put our forecast out into 2022 and 2023, we're actually assuming zero growth on a combined basis between iPhones, iPads, and Macs. So all the heavy lifting is going to come from services and wearables on a going forward basis. Not to mention, when we start thinking about the pipeline for our Apple, whether it be related to potentially augmented reality glasses, whether it be related to an eventual car in the future, foldable phones potentially, by 2023. There are definitely things in the pipeline that will help a lot of these existing businesses, as well as kind of expand their addressable market.
The concern a few years ago was, what's the next iPhone? And I think Apple was able to address critics by creating the next iPhone and continuing iPhone growth there, but also growing services to just a massive, massive business. Third quarter services sales were $17.486 billion. The consensus estimate was $16.32 billion. What is that next iPhone? What is that next services?
In terms of services, I really think it's hardware as a service. So when we start thinking about iPhones, particularly, think about being able to offer that iPhone as a service going forward. And
because it's so expensive?
Partly, yeah. I mean, but and we kind of look at the first iPhone coming out about $500 over a decade ago, and now you're looking at definitely higher priced iPhones, and clearly the shift towards even higher priced iPhones north of $1,000. I kind of highlighted foldable phones, but when we start thinking about kind of hardware as a service, I think that's really kind of the key in that elusive kind of pie in the wall opportunity for Apple. Think about Amazon, right?
Right.
Kind of that Prime subscriber base. When we think about Apple in a decade from now, I think you'll be looking at Apple and every consumer out there paying X amount of dollars to have all their services, as well as kind of that hardware. New hardware kind of capability every year or every 2 years, let's say. So I think that's really the opportunity long-term for Apple in terms of services.
Increasingly our household, a bigger chunk of our money goes to
while she
hardware.
wears an Apple Watch.
Yeah, and I have to say, I do see a lot more Apple Watches on everybody. Greater China revenue, Apple said, rose 58.2% from last year's pandemic trough of $14.76 billion. Overall services, as we talked about, up 33% to $17.49 billion.
I anticipate there will be a lot of questions on that call about Greater China and what Apple is thinking about when it comes to that region.
Angelo Zeno, we love talking with you. Senior equity analyst over at CFRA Research, on the phone from Long Island.
Let's get a check of the latest world and national news. For that, we go to D.C. with Nancy Lyons. Hey, Nance.
Hey, Tim. The CDC is revising its mask guidance and recommending people vaccinated for the coronavirus go back to wearing a mask indoors in certain areas of the country that are seeing a surge in cases. The Delta variant is apparently taking hold in states where vaccination levels are low. The current vaccines remain effective against the variant. The CDC is also recommending masks for all students and teachers in classrooms this fall. Well, it's also possible the administration will require federal workers be vaccinated as the Delta variant spreads. President Biden was asked about it today.
It's under consideration right now, but if you're not vaccinated, you're not nearly as smart as I thought you were.
Biden spoke after a visit to the Office of the Director of National Intelligence. The bipartisan House panel looking into the Capitol riot has been hearing from officers who defended the building. D.C. Metropolitan Police Officer Daniel Hodges minced no words in his opening statement, calling them terrorists. Hodges was the officer seen on video being crushed in a doorway of the Capitol.
The mob of terrorists were coordinating their efforts now, shouting, "Heave, ho, as they synchronized, pushing their weight forward, crushing me further against the metal door frame. The man in front of me grabbed my baton that I still held in my hands, and in my current state, I was unable to retain my weapon. He bashed me in the head and face with it, rupturing my lip and adding additional injury to my skull.
Hodges says one rioter tried to gouge out his eye. Another kicked him in the chest while trying to take his baton. Republican Congressman Adam Kinzinger told the officers that as bad as they may feel, they won that day. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Lots of earnings we're getting through, we've been covering. But one other story we want to get to by Patrick Clark over at Bloomberg talks about a startup that helps renters build credit until they can buy a place. It is raising $165 million from a group of investors that includes some people you might know.
Yeah, Sequoia Capital, okay. And then Rock Nation from Jay-Z and Will Smith's Dreamers VC.
Yeah, exactly. Landis Technologies, founded by Cyril Berdugo, I think I'm saying, and Tom Pettit, caters to would-be home buyers or homeowners who can't afford to buy. The company buys a house, rents it to the client until they can qualify for a mortgage. The client can then buy it back at a predetermined price up to 2 years after the initial acquisition. So it's really helping somebody kind of find their footing when it comes to home. It's so tough those first couple of years, maybe having the down payment and so on and so forth.
And probably tougher now than ever before. The model is a spin on the rent-to-own strategy that's been employed by other companies, including Home Partners of America, which Blackstone Group recently agreed to acquire for $6 billion. As part of its service, Landis, for its part, provides coaching for clients on how to manage their finances to improve their credit and save the amount they need for a down payment.
So here's how it works. The company's typical client, Tim, first-time home buyer with a budget between $110,000 and $400,000, and this group is buying roughly 1,000 homes in that range. They are looking to convert roughly 80% of its clients from renters to buyers, a rate that would far exceed traditional rent-to-own companies in the U.S. Landis sets rents equivalent to its carrying costs on the home. It also charges a fee on top of the value of the property at the time of its initial purchase. If a client isn't ready to buy the home after 2 years, Landis may offer them more time or sell the property. So a lot more wiggle room than a bank would provide.
And here's something that's interesting when it comes to the incentives. Cyril Berdugo said, quote, "We make money when our client buys the house back. If we leave money on the table, that's our problem."
It's a very different model.
It is.
And it's providing really a financial pathway for many who otherwise couldn't buy a home.
Homeownership in the United States has been looked at as a way to provide access to capital in retirement, but increasingly it's more and more expensive to buy a home.
Right. It's a pathway to wealth creation, which is really key. This is Bloomberg Radio.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Earnings, lots of them after the bell. We begin with the big one. Apple reporting record third-quarter revenue on demand for iPhones, iPads, and services, bolstered by retail stores reopening globally and consumers embracing new 5G networks. Apple topped estimates. Service revenue hit a record. Apple shares little changed right now. They are bouncing around, but down by about 0.4%. Google parent Alphabet reported quarterly sales that topped Wall Street estimates, driven by robust digital ad spending from marketers eager to get consumers buying again during an uneven pandemic reopening. Google parent Alphabet down now by about 0.9%. Microsoft reported sales and profit that exceeded analyst estimates for a 10th straight quarter. Shares, though, trading lower by about 3.5%. Investor optimism is being tempered by concern about slowing growth in the software giant's Azure cloud computing business. S&P had its worst day in a week, slumping 20 points ahead of all those tech earnings. S&P down 0.5%. The Dow down 85, down 0.2. Nasdaq down 180, a drop there of 1.2%. 10-year up 15.30 seconds. 10-year yield 1.23%. Gold up 0.1%, 17.99 the ounce. West Texas Intermediate crude 71.91 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. It is a busy Tuesday afternoon. So, Tim, how often do we talk about companies going all in on digital, or hear from leaders, CEOs, and more saying that's exactly what they're doing, especially during the pandemic?
I mean, that is exactly what we heard over the last 16 months.
Right. And our next guest says, fine, you can go digital, but it really needs to be about blending digital and traditional business functions if you want a competitive advantage long term. I think it's so timely that we're going to talk to this guest, especially on a day when we're all in on big tech and we're talking a lot about digital strategies.
We certainly are. Rob
online.
Siegel is a general partner at Exceed Capital, also a lecturer at Stanford's Graduate School of Business, and the author of The Brains and Brawn Company, How Leading Organizations Blend the Best of Digital and Physical. He joins us on the phone from Silicon Valley. Rob, how you doing?
I'm doing great, Tim. Thanks for having me.
What do you think of when you hear a company say what Carol just said? Because they tell us that all the time, that the key to growth is making sure that you disrupt your existing business model, but do it in a way that allows you to not actually cannibalize what exists already.
Well, digitization is really, really important, but it's not a panacea. And increasingly what I see through the companies I invest in as a venture capitalist, but also those that I get to study through my work at Stanford, is that the best companies right now are blending the best of both digital and physical. And we saw this, the pandemic accelerated this, that it wasn't just enough that we could shop online and communicate online.
You're all about you're all about case studies in this book. So give us a few examples of some of these best companies.
Well, so on the retail side, we saw magnificent performance from Home Depot, from Best Buy, and from Target, who really invested in infrastructure and logistics, as well as a great digital capability where people could shop that way. And we also saw, obviously, Amazon has done a tremendous job. And so we're seeing organizations in functions like retail, financial services, even healthcare doing a great job of making sure that there's both a digital and physical component to everything that they do.
So, it's an interesting time, too, to be talking about this, especially when we've seen increased Chinese oversight of their big tech companies, specifically about data collection and China wanting more, the Chinese government wanting more control. Do you believe that because of this combination of brains and brawn, that some of those big tech companies, they do have too much focus on kind of the brainy element of what they're doing, and that they need to be either more diverse or more government oversight?
Well, you raise an interesting point, Carol, in that what's going to end up happening is how supply chains will reconfigure, where manufacturing jobs are going to be placed, is a function of the global economic competitiveness, largely writ by the challenges between the United States and China. And so no matter what you manufacture, no matter what you deliver to your customers, as every good becomes connected, right? There's a software component and a connectivity component to everything. Digital organizations are going to have to think about where they're going to put their factories. And factories can be, traditional, manufacturing factories, but you also have additive manufacturing, which will allow you to put basically factories at your customers' client sites. And so companies are going to need to think about how they construct all of their digital and physical attributes. And historically, companies here in Silicon Valley haven't had to do that, and that's going to have to change.
Hey, Rob, we can learn a lot from companies that have been really successful in this transition, but we can also learn a lot from companies that haven't been. What are some examples of companies that didn't successfully make this transition, and we can learn from that?
Well, you can think about, like, for example, Borders back in the day did not do a good job of figuring out what Amazon was going to be doing to their business, how they partnered, how they, made sure they talked to their customers. And we're seeing, I think, a lot of the large mobility companies really struggle. One of the companies we look at in the book is Daimler, which is a manufacturing and design engineering powerhouse, but they've really done a very poor job on connectivity, on software, and so they're really struggling behind companies like Tesla, which are going to do a phenomenal job and are doing a phenomenal job of designing cars digitally first. And soon, as you mentioned China earlier, China will become an export player in the automotive market. And so you can see a lot of the incumbent car makers really trying to fight what they were doing before, which was basically bending metal and designing great machines, instead of thinking these devices as, if you will, moving sensors on wheels.
Well, it's interesting, and I think about, in particular, our audience. How do they need to think about what you're saying in terms of long-term investment plays?
Well, if you are thinking about a physical company or something with a physical DNA, one of the questions you want to be asking is, are they investing in things like analytics and digital infrastructure? Are they hiring the right type of people? Are they, developing competencies in ways that they can communicate with their customers? We also need to think about, are they changing, creatively their business models as well as the technologies that they develop? Are they really reaching out to their customers? One of the companies we studied was Kaiser Permanente, the large healthcare provider. And, Bernard Thompson used to, when he would come to Stanford and talk to the students, really kind of showed empathy for all the players in the ecosystem, his doctors, his nurses, the communities he was in, the patients. And he really understood where everybody was shaping their business. And so the question we have to ask about the large incumbent organizations, are they doing those things? Are they really taking risks and running towards the disruption, or are they just trying to hold on to what they have before?
All right. So it's interesting. If the companies don't get it right and do that combination, Rob, of brains and brawn, then what?
Well, then everybody who works there should probably update their LinkedIn profile because, what's going to happen and what digital enables is you have companies that can come into new market segments and maybe you didn't see them coming. I mean, a great example of that is Stripe and what Stripe has done in payments and transactions in ways that a lot of the large existing players didn't see, who were in kind of the whole transaction and merchant processing accounts. And so you've got to really kind of be playing offense on this because you don't always know where the attack is coming from. What happens when Uber and Didi go into logistics, and what impact is that going to have on Federal Express and UPS and DHL? So people are going to be completely rethinking their business models and the technologies and the market that they can go after.
Hey, Rob, I always like to ask, and we only have about 20 seconds left, people who teach at business schools, lecture at business schools, you lecture at Stanford, where do your students want to go work right now?
So it's funny, a lot of times they want to actually go to what I'll call the sexy tech companies, or they want to start their own companies. We are starting to see a lot of, of the students, and we teach students from all over the world who are actually looking at a lot of the larger established organizations who are doing some really interesting things. So it's not just that everybody wants to do their own startup anymore.
Right.
We're starting to see people who actually want to go in and actually have some big impacts in some of the larger organizations because they see some really exciting things going on there.
That is an interesting trend. Rob Siegel, thank you so much. Really enjoyed this. General partner at Exceed Capital, author of The Brains and Brawn Company. All right, let's get to Joe Matthew. Sound On coming up in just a moment. We know what you're going to be talking about.
Yeah, well, it has something to do with a mask, right? Are you wearing yours?
Yeah, we'll be as soon as I'm in the studio.
Handy. A fascinating conversation coming up with an expert on health law, global health law.
Got it.
And we'll talk about it straight ahead on Sound On.
Looking forward to it. All right, everybody, have a good evening. This is Bloomberg.